Welcome to Talk Tickers, where we break down the numbers that matter. Today, we're jumping right into Cameco's third quarter. Now, the stock took a pretty big hit right after the numbers came out. But was that the right move by the market, or is there something bigger going on here? We're going to dig in, separate the signal from the noise, and figure out what the real story is with this nuclear energy giant.
All right, here's what we've got on tap. We'll start with that headline miss, the numbers that made everyone a little nervous. Then we'll get into what management is really focused on, their long game. After that, we've got the big one, the Westinghouse catalyst. Seriously, you're not going to want to miss this part. We'll wrap up by looking at the bigger picture for uranium, and then, of course, give you the next call, our rating on the stock.
Okay, first up, the headline miss. So let's deconstruct the numbers behind that initial drop. Why did the stock sell off right away? Well, it all comes down to the headline numbers. Let's see exactly what the algorithms and the fast money traders saw that made them smash that sell button.
And here it is. This is the number that really did the damage. Adjusted earnings per share, just 7 Canadian cents. Now, you compare that to what Wall Street was looking for. They were expecting something like 23 to 28 cents. That is a huge miss. And for a stock that's priced for a lot of growth, a miss that big, it's an instant red flag for the market, no question. And, it wasn't just the bottom line. The top line, the revenue, also came in pretty light. We're talking a 15% drop from the same quarter last year. It went from about 721 million Canadian down to 615 million. Now, this was mostly about the timing of their deliveries and lower sales volumes, even though the prices they got were actually better. So, kind of a mixed bag, but the headline number is what grabs you.
All right, Section 2, Management's Long Game. This is where we look past all that quarterly noise and get to the core strategy. Because look, the numbers on the screen tell one story, right? But on the earnings call, management was painting a completely different picture. They were basically telling investors, hey, ignore the short-term stuff, focus on where we're actually going. So let's break that down.
The message from the CEO, Tim Gitzel, was really clear. Execution is key. He kept hammering this point home, that they are in an exceptional position to execute and deliver value. What he's really saying is, yeah, we had some production hiccups this quarter, but don't worry about it. We can deliver on our big long-term contracts. It's all about positioning themselves as the go-to reliable supplier in a market that's getting tighter by the day.
So the big question is, how are they dealing with these production delays at their main mine, McArthur River? Well, this is where it gets really interesting. Instead of going out and buying super expensive uranium on the spot market just to fill orders, they're being clever. They're dipping into their own strategic inventory and using product loans. And that is a huge advantage. It protects their profit margins and shows a kind of financial discipline that, honestly, the smaller players in this space just can't match.
And that brings us to this key word that kept coming up on the call, tenor. The length of a contract. See, they're not just out there chasing the highest possible price for a quick 1 or 2 year deal. No. They want long-term contracts. We're talking 10 years, even longer. Why? Because those long contracts are what you use to finance and build out new production. It's a much more disciplined, sustainable way to build the business instead of just reacting to every little price spike.
Okay, moving on to the Westinghouse catalysts. And let me tell you, this is the partnership that could change the entire investment thesis. If you take away one thing from this analysis, it should be this. We're not talking about one quarter's earnings anymore. We're talking about a deal that could literally define the next decade for this company.
All right, I want you to forget about that 7-cent earnings number for a second and look at this number, $80 billion. And that's the minimum commitment from a new partnership with the U.S. government and Brookfield to get these Westinghouse reactors built. This is a massive, government-stamped seal of approval. It's basically the White House saying, yep, the American nuclear renaissance, it's happening, and this is how.
And get this, the way they structured the deal is just brilliant, especially for shareholders. So here's how it works. Step 1, the U.S. government helps with the financing to get these new reactors off the ground. Step 2, construction starts, which gets the whole domestic supply chain humming. But here's the best part. Step 3, the government only earns a piece of Westinghouse after a whopping $17.5 billion Canadian dollars in distributions have already gone to the current owners. That's Cameco and Brookfield. So investors get paid first. It's a fantastic performance-based deal.
Okay, next up, uranium's bigger picture. Because it's absolutely crucial that we zoom out for a second. This huge Westinghouse deal isn't happening in a vacuum. You have to place this company-specific catalyst inside the broader industry trend, which, by the way, is already incredibly strong.
Yeah, the entire nuclear sector is having a major moment, and it's being driven by these massive, powerful macro tailwinds. You've got energy security, everyone wants to control their own power source. You've got decarbonization goals, which is obvious, and then you have the explosive growth in electricity demand from things like AI and data centers. And the best part? This has bipartisan policy support. It's not a political football, which means the trend has legs.
And you can see the effect of this right here. I mean, look at the one-year return. Cameco, that's CCJ, is up almost 86%, while the broader uranium ETF, URA, is up about 67%. So yeah, the whole sector is doing well, but Cameco is clearly outperforming. The market already sees it as the best-in-class name, and that's before most people have even fully wrapped their heads around the Westinghouse deal.
All right, that brings us to our final section, the next call. We've looked at the headline miss, but we've also looked at these absolutely massive long-term catalysts. So where does that leave us? What's our rating and what's the trade idea?
So here's the big question for any investor looking at this. After a messy quarter like that, what's the trade? How do you position yourself from here?
Simple. Our rating is outperform. We think the market is making a classic mistake here. It's getting bogged down in the short-term noise of one quarter and completely missing the huge transformational shift that's happening with this company.
Okay, so let's break down our thesis. The bull case is pretty straightforward. That Westinghouse deal is an absolute game changer, and the nuclear macro trends are only getting stronger. The bear case? Well, maybe these production delays drag on, and maybe the contracting environment doesn't improve. But our view is that this post-earnings dip is a total head fake. It's an entry point created by short-term thinking. The market is staring at the quarterly production numbers, while we think the real prize is that $80 billion Westinghouse growth story.
So what's the trade idea? Well, for those who are comfortable with it, you could look at long-dated call options. This lets you capture that potential upside while strictly defining your risk. You can only lose what you pay for the option. The whole point is to get positioned now before the rest of the market catches on. We're betting that the narrative is going to shift away from this messy quarter and toward the massive Westinghouse catalyst, and that shift is going to happen before the next earnings call.
And of course, remember, this is not financial advice.